What's up, y'all? Just wanted to hop on here real quick to compare what an FHA loan and conventional loan looks like in regards to payments at a $350,000 price. And these are real rates that I pulled here, 1016. All right, before I hop into all the little details, real quick, FHA, they're typically going to have lower rates than conventional, but there's also higher fees with FHA. FHA, you're going to be paying an upfront mortgage insurance premium, which is going to be 1.75% of the loan amount. So if $350,000 is the purchase price, and with an FHA loan, you're going to put 3.5% down. So 3.5% down is $12,250, right? And so you're going to do the math. Like I said, 337 is what you get once you subtract your down payment from the 350. And so you're just going to multiply the 1.75 by the remaining amount, which is going to be 5,910 and 63 cents, which is what this number here is, including the funding fee is right there. But so FHA, 1.75% upfront fee. Conventional loans are not going to have an upfront fee. Conventional though, you're only putting 3% down. That's the lowest conventional will go is 3%. Lowest FHA goes is 3.5%. 3% of 350,000, you're looking at $10,000. $10,500 would be your down payment. So down payment FHA is 12,250. Over here, we're looking at $10,500, right? And like I said, rates higher with the conventional than it is with the FHA. And the payments, you can see here the 2410. Over here, we're looking at 2446. That's just your principal, interest, and your mortgage insurance. So that's not factoring your taxes. This is factoring the taxes and then your other insurance, your homeowner's insurance, which are these are just estimates, right? When we look at the total amount of payments here, this payment here, both of them, that's including your principal, interest, your MIP, which is your mortgage insurance premium, your taxes, and your insurance. So that's what your payment is consists of. Principal, interest, taxes, insurance. So our taxes here are $365 a month. Same thing over here, $365, and that obviously wouldn't be accurate. I think that's like a 1.5%, something like that. And taxes here are, at least here where we're living at here in Austin area, they're above 2%, so it would be higher. But just for this example, we're looking at 365 in taxes, insurance 102, same thing, insurance 102. The payments are different though. So what's different? These two things are different, right? Our principal and interest, because our rates are different. Mortgage insurance is $130 over here. Mortgage insurance is $238 over here. Why are they different, right? So just like there's a upfront mortgage insurance premium, which is called MIP. So FHA loan uses MIP, stands for mortgage insurance premium. Your conventional loan is going to use PMI, which is your private mortgage insurance. Your private mortgage insurance, it's typically going to be lower than your MIP, right? Your mortgage insurance premium, but it could be higher. It really depends. It considers the LTV and your credit score. So the better your credit score, the lower your interest is going to be. Over here, though, with the FHA loan, your credit score does not matter in regards to how much they're going to charge you for the MIP. It's a percentage that's based off the loan amount and the LTV. And so over here, they're using 0.85% is the actual number that they use. So what they do is they take 0.85% and they're going to multiply that against the loan amount, right? Which we said was 337,750, right? So 350 minus your down payment, it's going to give us 337,750 times 0.85%. It's going to give us $2,870. So $2,870 would be your annual insurance. That's where this comes from. But then you're going to divide that 2870, the 2870, divided by 12, because there's 12 months in a year, and it's going to come down to the 238 a month. That's where that comes from. This one, like I said, this one's varies almost person per person, right? Because everyone's scores, credit report are all different. So that one's going to vary. In this example, though, it's set at 130. And so the payment on conventional is higher than it is for the FHA by 40, 50 bucks or so, right around there. Even when you look at just your principal, interest, and your mortgage insurance, same thing. Looks like FHA is still a little bit lower right here by like $36, 24.46, 24.10. And then this is where it's different, right? So now we got closing cost. And closing costs are charges on top of your down payment, right? That's your lender fees, title fees, attorney fees, all that stuff. Over here, it's $15,000. So you would need your down payment, right? Which we said was $12,250 plus your closing cost to get your total cash to close. Over here, you need $22,759. Over here, we need $21,643, right? But closing cost for conventional, we're seeing is only $9,000. Over here is 15. This is considering though that funding fee or the MIP fee, the one up front, that 1.75% that we said earlier, that's including in there. So really, it's a similar. There's similar closing costs, but this is going to have that upfront fee tacked into here. So, but it's not paid out of pocket. You unless you really wanted to pay it out of pocket, but most people are just going to roll it into the loan, right? So out of pocket, you're typically looking at around here. The extra $5,910 for that mortgage insurance fee is going to be rolled into the loan amount, which means that your loan amount is higher, right? So if we go back up here, your loan amount for the FHA loan is 343. Over here is 339. Even though you're putting less money down on the conventional loan, right? You only put 3% down, which is 10,500. And over here, you're putting more money down. So theoretically, if you're putting more money down, your loan amount should be lower, but over here it's higher. So conventional, what we're seeing is a higher payment, higher rate, but we're seeing a lower loan amount, right? 339. So if you were to get this loan, when you look at your balance, you owe 339. Over here, you owe 343 because of that funding fee, that upfront mortgage insurance premium we said, that 1.75% or the 5,900 is tacked onto that. So your loan amount's higher. So let's look at this. Total amount of interest. Obviously, the lower interest rate, you're going to pay less in interest. Over 30 years, you'd pay 438 in interest. Over here, you pay 494. That's about what? Around $60,000. Just make that up, $60,000 or so in interest. And then in total payments, over here you pay 839. Over here you pay 852. Assuming you keep the loan for 30 years, you never refinance. Most people are going to refinance if they have a higher rate, right? As soon as they can. So in this scenario, like why would someone go the conventional route instead of FHA, right? So it depends if you're looking for the lower payment. The problem with, not the problem, but I guess the trade-off here, right? There's a lower rate where you have more fees, so you have a higher loan amount, higher rates. You don't got any upfront fee, so you have the lower loan amount. The difference here, though, the conventional loan, it's the easiest one to get rid of your mortgage insurance, right? Versus over here with the FHA loan, if you only put 3.5% down, this insurance stays there for the life of the loan, right? And so the only way you can get rid of that is pretty much refinancing into a conventional loan whenever you hit 80% LTV. Or if you were to put 10% down, which means you have to put more money down though, If you put 10% down on the 11th year, this could drop, right? But over here with conventional, this drops once you hit 80% LTV. With time, if the value of your home goes up, or as you're paying down the principal, once you get to that 80% LTV, loan to value ratio, you can get rid of this, right? So then if we're looking at it like that, if you're thinking of it long term, right, then right now this payment is higher on the conventional, but if you were to get rid of that mortgage insurance down the line, then your payment's going to drop, right? And it'll drop down to 2783, getting rid of this. So now this payment would be 2783 once you get rid of this, but this payment would stay like this because you can't get rid of your mortgage insurance premium. So down the line, this payment would be lower. The other differences there is that FHA, your minimum credit score could be they go all the way down to 580. So 580 is the minimum that FHA will take. Conventional, it's going to be a little bit higher. The minimum credit score there is going to be 620. Other than that, really, FHA has easier guidelines. That's why you have more insurance over here, because they're higher risk loans for the lender, because they're a little bit more lenient with their guidelines. So it's easier to qualify for an FHA loan than it is for a conventional loan. What do y'all think about these rates? FHA 6.5%, 7.25, a conventional. At the beginning of the year, like back in January, rates were in the 3%. So they've like doubled, right? But what's also happening is that as the rates keep going up and up, you're seeing home prices kind of start leveling off, start going down a little bit. So when you look at listings, if you're shopping for homes, what you're going to see, I just quickly hopped into realtor.com and I just looked at Round Rock. You're going to see price cuts. Right, so that's what's going on. There's a lot of price cuts now. So right here, $32,000 price cut, $20,000 price cut, $15,000 price cut, $32,000 price cut. We got 20, 20, 26, 8, 25, 25, 25, 20. So you're seeing a lot of price cuts, right? And it's happening pretty quickly. Like if we just hop right here, for example, let's see. Property history. Look, the house here, they listed it 1002, and then just 5 days later, they dropped it from $629,000 to $597 in 5 days. Over here, we have a $20,000 price cut. Let's see. They listed it September 30th. About 15 days later, they did a price change and they dropped it from 449 to 429. Over here we got a $32,000 price cut. And that happened, let's see, 2017, 2022. So 929. What else we got over here? Try to find a good one. Oh, look, 30,000. This one's too. Well, these are nice houses, huh? Let's see. Listed at 1006, at 774, and they dropped it 744. $30,000, 1014, listed at 1006. So just a few days later, dropped. Let's look at this one. Listed at 1006, 1014, they changed it from 620 to 590. And so if the homes don't sell, what's going to keep happening? And look at these are new construction. So you're seeing builders also starting to reduce prices. Let's see what else we got. Oh, about 25,000, 25,000. How quick what I'm looking at is how quick it's happening, 924 listed, price change 1012. This is new construction. 1007. Well, they've been steadily, so they listed it 923, Obviously hasn't sold. 927, they reduced it from $10,000. And then 1003, they increased it back to the original. That's what builders do sometimes to notify that there's been a price change. So list it at one price, drop it, increase it again so it shows up on your radar. It looks like on 1007, a few days after that, looks like they increased it again. And then obviously still hasn't sold. 1013, they dropped it down to 422, which was lower than it started. So I think that's saying something. Is it a good time to buy? Rates are higher, but that also means that there's less demand or there's less buyers looking for homes, right? Because it's pretty discouraging seeing rates. It's harder to qualify because of the higher rates. There's higher payments. Sellers are reducing prices, offering seller concessions, offering lower your rates, all that stuff. So it really depends on your personal situation, whether it's good or not, or good time or not to buy. Y'all hit me up if you got any questions, or if you want to look at rates, payments, or just price a little scenario out, hit me up.